So I'm Akshay, and as Raj has introduced me, this welcome all to another edition of our monthly webinar on the derivatives outlook as to how we see the market, that is the Nifty index for the month of March. So if you look at the current month, the way things are unfolding, it's we are dealing with a situation for the month of March. Now the situation, as everyone is aware of, is more of a black swan event, you can call it, because it's an event. It's the war between US plus Israel, who are attacking Iran, and this is causing serious repercussions in the world market. Now volatility is the key, because that's how things are shaping up. There has been extreme volatility, and the volatility index, which is the India VIX itself, has a story to tell. If you look at how the VIX has moved in the last 1 week, the war kicked off last Saturday, and since then, VIX has almost hit a high of roughly around 19 to 20. And that is the state of affairs. When VIX goes up, it means the option premiums are going expensive. And why do they become expensive? It's because there is sudden need of hedging. Out of the money puts are being bought, and serious volatility in the market also causes the put writing positions to be squared off, which further aggravates the situation for the Nifty index. So volatility is what we are dealing with, and it's a very difficult time for the market if you're a short-term trader, because right now the trend in the market is that it is one way down, and somewhere there is a small short-term support building up at one of the key levels, which is roughly around 24,300. Now we will try to make life more simpler for you. We will do our best of our analytics in the next 10 to 15 minutes as to how you should be navigating the month for the March in the current situations, which are the important technical level you should be watching out for, how the positioning stands in the derivative markets, and how accordingly you will strategize in terms of options, the best strategy which we feel is the right approach for the month of March, and which are the key sectors you can look forward to, both from a profit booking point and from a fresh long addition point, sectors which should deliver or at least give you a safe haven in the month of March. So first of all, taking the presentation forward, the immediate support, as I mentioned, for the Nifty is 24,350. Now, this level was tested this particular week. We did see some rebound intent from the levels of 350, 24,350, although it is the very initial phase to conclude that 24,350 is a support or not. But if you look at the monthly charts of the Nifty index, last year in August-September time, that was exactly when we did see a base building up around the levels of 24,350. Hence, we are attaching so much importance to this swing low of 24,350, and that's exactly from where the market has also shown an intent of reversing from severely oversold levels. Now, one important thing, what we should be looking forward is, where is the resistance for the India VIX, and where is possibly the market trying to support out. Now, VIX, which is India VIX, has a resistance at the levels of roughly around 22 to 23%. Recently, we made a high of around 21% and from there we cooled off all the way till 18%. Today, on weekend tensions, again there was a spike up in VIX. So somewhere where we can anticipate VIX to resist, or where Nifty may potentially bottom out, is the levels of 24,000. That comes into play if 24,350 is broken. So 22-23% resistance on VIX roughly coincides to around 23,900 to 24,000 level on the Nifty index. So we are talking about a scenario where one important support is 24,350, and if that breaks, 24,000 level comes into play. But we do not see any significant downsides as of now in the market below 24,000. Now there are two factors. When we started off with the March month, there was no fear about war. People talked about a possible there might be some peace talks in Vienna last week, which we were talking about on Friday. But war suddenly came as a surprise, and hence we are having such sharp reactions right now in the market. Today, as we stand, we know that the war is on. Things can get worse than this, but at least we know for sure that this is the clarity that the war has broken through, and what are the worst case situations which one can look forward to. So missiles will be fired, there will be talks which will be exchanged, there will be some news about possible de-escalation which will be coming in from now and on. In short, volatility will continue, but whatever has to happen has happened. We know the news for sure, and when the market knows some things for sure, at least you know that there may be some chances of a support in the making. So right now 23,900 or 24,000 is the worst case bottom which we are as of now looking forward for the month of March. Obviously, if things do turn worse than that, we will be keeping you updated on as of now. But as the current data points read, as the current situation goes, we are working with a basic cap or a downside of 24,000. Now, on the upside, in case there is any positive statements to come forward to, the best case scenario, if you were to look forward for the month of March, stays around 25,000 to 25,200 zone. So clearly, if you want to take a view on the market, really it is a downtrend, it is a weak trend, and it's a sell on rise market only for the month of March. Where are you going to make any attempts to buy or do some bottom fishing? That should be around 24,350. That is strictly only for traders. And if 24,350 breaks, 24,000 is the next level which has key importance in the current scenario. And that is another level to take a decisive call on buy on the market with a strict stop loss below 23,800. So this is the setup. It's going to be choppy. We are trying to make the best of this range, which is 24,000 to 25,000. We are trying to time bottoms around 24,000 to 24,300, and we are trying to look for exits roughly on any recoveries around the levels of 24,700. That's more of a trading point, and the best case scenario around 25,000. That's how the approach for March should be if you are a directional trader. As per the derivatives data, now we are moving from the technical aspect to the derivatives point. The max pain is a point which is more of a pivotal level. This point comes into place when you look at the options chain on the monthly 30th of March expiry. And that suggests that 24,000 is more of a pivotal level for the derivatives data. That's the point from where plus minus 500 points, the Nifty may fluctuate. So roughly 24,000 on the lower side and 25,000 on the upper side. The picture which I spoke about 2 minutes back is what even the derivatives data has to say, the options data has to say. So clearly we are going to be choppy, gravitate around the epicenter, which is 24,500, and that is a max pain point which we define for the monthly 30th expiry. PCR, which is the put call ratio, which suggests how the calls and the puts open interest is positioned, clearly indicates that there is a heavy presence of call writing. And although the VIX is rising, the call writers are positioned themselves, the safe call writers at 26,000, the moderate risky call writers at 25,500, and the highly more of a risk takers at 25,000. But these are the areas or the strikes where call writing is very visible. And for any short covering to trigger, the first point is any sustenance about 25,000, and that is pretty far from where we are right now. The premiums are also very significant. So right now, even call writing at deeply out of the money strike are offering you good opportunities, although they may not immediately give you the returns if there is a spike in the market. But from a 30th March expiry perspective, 25,500 and 26,000 are safe, comfortable levels if one is planning to write calls, and you can look at them as actionables in case mark to market is not a worry for you. Bank Nifty. So we have done with Nifty. We are talking about Bank Nifty, where as 2 days back, Bank Nifty was an outperformer. Things are slightly changing now. There has been some profit taking, which we have noted in the PSU bank, which was one of the most strongest counter till now. Private banks are also taking a hit. Bank Nifty is dealing with one of the most important supports, which is around 57,000, which it closed. And any breach from the levels of 57,000 can be a trigger point for the Bank Nifty for a massive 2,000 point move on either side where we currently trade. So you have to be very careful if you're placing an options writing trade in Bank Nifty at this point, because this is where Bank Nifty may swing wild. It's been consolidated in a broader range of 57,000 to 61,000 in the last 3 to 4 months, and now it is time that Bank Nifty lets loose of this range. So be careful when you're writing options in Bank Nifty, especially whether it is straddles or strangles. There is a good chance that there can be a gamma explosion or an options premium explosion from the current point where Bank Nifty is poised. It can go either ways. So we would first of all advise go very easy in option writing in the Bank Nifty at the current level where it stands. 60,000 is the psychological resistance, and right now we are almost near the support base of 57,500. That is how the trading setup stands for the bank index. Moving next to how the FIIs and the DIIs are placed. So if you see the top screen, it talks about what is happening since the last 3 to 4 trading sessions. So clearly the numbers are not good. That's what is expected. In a war-like situation, you will have the FIIs selling out in both the cash and the F&O space. And DIIs are the ones who are cushioning in this selling, and they are the ones who are taking the hit and absorbing the sell pressure to the best they can. These numbers are clearly evident to you on the top slide, where around 15,800 crores of selling has been seen in cash, and around 25,000 crores has been absorbed by the DII. So clearly, although we see the price damage done, the significant extent of this damage has been saved by the DIIs in the last 4 days. But if you look at the lower end of the picture, which is more of a monthly picture here, FIIs have been selling in the Indian markets since the last few months. 6 months of data, there has been continuous sell numbers in the cash market. F&O market did see some bit of a silver lining in February, where the long short ratio, which is how the FIIs are positioned in index futures on the longs and the shorts in open interest, that did improve initially before the war situation. It improved from around 8%, where it was lagging around since November, December, to around 23% at the fag end of the February month. And that's why you have a buy number of 4,600 crore for February 2026. But in the last 4 days, the long short ratio again has cooled down, and we are noting the long short ratio around 16% of longs compared to around 84% shorts. So that's the story. FIIs are sellers in Indian markets, and do not expect any fireworks, at least from their end, unless there is a major cool off in the global tensions which are currently dominating the news proceedings. Next, we talk about the key triggers. As I said, geopolitical stability. If you're not following news, watch for the volatility index. It has a lot to say. Even if you put on news, there will be a lot of scare in the market because they will be reporting as in when what things are happening. But the market sentiments would be reflected by the volatility index. That is where you should be looking for. If VIX cools off any point below 18, that's an indication that at least there is some stability trying to get back in the system. Comfort will come in if VIX gets below 15. That's very far from where we are right now. But if you were to draw the lines, 18 is the first point below which if it cools, at least some short-term support is in the making. If it cools below 15, that's more of a, you can say a breathing space which the markets get in the current scenario. That looks very unlikely for March, but these are the levels you need to keep in mind. And 22-23% is the extreme end as of now, defined by the technical parameters on the VIX. If it goes there, that's the point where you can take some hard risk writing positions, because that's more of a breakout point for the VIX. If it breaks 23, then there is a problem in the world. That's what the conclusion is, which VIX will drop. So keep these levels in mind on the VIX. Any de-escalation in the Middle East will trigger massive short covering, a potential 3 to 5% move, but those are all subject to news, and till the news hit the market, we should not be concluding as to what may happen. We have to be with what the VIX has to say and what the prices have to say. The rupee hitting records of 92.3 is another headwind for the F&O traders, as the import-heavy sectors like oil and crude, oil and auto are taking hit. Now, really, which sectors you will be looking forward in all this mayhem? What we understand looking at the last 4 days of action is that there seems to be some margin calls in the market. Now, why do I say that? Because there were some sectors which were very strong and holding on despite the volatility by the fag end of February and the month of March. These were the PSU space. There was the metal space. There are some stocks which were doing exceedingly well and they had little to do with the market. But in the last 4 days, suddenly these stocks have taken a hit. There has been selling even in precious metals like gold and silver. And that is probably the reason, because there are margin calls, and in order to fund these margins, profit booking in these strong names are what we are witnessing, especially the banking and the financial services names which did well in February are noting long liquidation, and the money is being used to fund your margins because of the losses being taken in the leveraged counters. Now, the safest play in the current market situations, if you are thinking of buying in the market, will be the pharma and the FMCG space. Till now, the FMCG has been more dormant. There has been some buying intent, but not aggression has been noted. But we believe that there might be some buying which may be seen in the FMCG space in the coming week. So stocks like an ITC, then an HUL, a Nestle, a Britannia, or a Varun Beverages. These are some names which have been lying dormant. They have not broken down much in the last 4 days, but if the flow does chase the defensive names, you can see some, some green shoots or some bit of life returning back in the FMCG space, some 3 to 4% upside in the coming week. Pharma has already started this move. Many pharma names have noted buying in the derivative space. Volumes or delivery-based buying in cash is evident in most pharma names, and probably the safe haven or money for short-term perspective is chasing the pharma names if you are looking to be on the buy side in the current volatile scenario. And obviously, I need not be talking much about the shipping and the defense names, because it's pretty evident in the last 3 days that the rub-off effect of the war is where the defense names are taking a positive impact. And stocks like an HAL, BEL, Bharat Forge, Mazgaon Dock in the shipping space, these are noting buying action based on the current theme in the market. So clearly the rationale is that there is booking, long booking. There are no major shorts as such, but booking is evident in the banking and financial space. IT has already taken a hit on the chin, so I doubt that furthermore there will be more damage from the current levels, although the technical setup and the derivative placement continues to be weak. It is too highly oversold that it may further see any major fall for the month of March, but really you cannot expect any V-shaped recovery. So clearly it's a sector at least to avoid for the time being till we have bottom confirming signals on the IT. Go for safe haven, which I mentioned, that is pharma and FMCG, and defense stocks will be more on the buying side if you prefer chasing the momentum. This is a market where supports hold rest level events. They may be immediately broken off. There is market-wide selling pressure. So really bottom fishing is not the way to approach unless and until you get stability in the market. That's the theme which I believe would work well in the current month. Next, we always try to come up with a strategy for our option traders. And, considering where we are in the volatility index, which is around 21%, we strongly believe that VIX has a resistance around 22 to 23%. And going by the past history of the last 3 years, VIX has time and again resisted around 22 to 23%. So we need to be bravehearts, stick our neck out and say that around 22%, we are going to take an option writing bet. It's a risky bet considering the war scenario. But if you are open to taking this, try writing options with proper cover or hedges once VIX reaches around 22 to 23%. So the best strategy which we devised, because premiums are too juicy to ignore at these levels, and deep out of the money options have good premiums on offer at the current market scenario. So we are devising an iron condor strategy, which is more of a strategy which plays on the theme that we devise a broad range for the market for the month of March. And if the market expires within this range, we get to keep the premiums for which we write the options. So what we suggest is you sell a 25,500 call, which is almost around, you can say, 1,200-300 point away from where the current market prices are closing. And you would sell a 23,000 put, which is almost 1,500 points away from where the current market trades. So 1500 is a good buffer, I feel, considering almost major part of sell-off on war news has happened, and more 1500 points to fall would take some serious damage to the global economy if that were to happen, and we would not be getting into those scenarios as of now. So we are setting this range of 25,500 on the upside and 23,000 on the downside to sell options, right? To sell options. Now we have a range in place, and considering the volatility, we need to protect this range by buying further deep out of the money options, for which we are buying a 26,000 call to protect our 25,500 call, and we are recommending to buy a 22,000 put, which would to a certain extent help our selling in 23,000 puts. So although they may not give you the proper hedge or cover, at least the margin requirement for the strategy would go down if you were to deploy this deeply out of the money option buy against the writing commitments you have. So this is the iron condor you set. The stop loss is below 22,900 and about 25,700. We are keeping a level based stop loss and not recommending you to hold the strategy all the way till the month of March, because the risk reward is not skewed. It might be a risk of 3, a reward of 1. So we would not like to keep the strategy open all the way till March. We are recommending you a stop loss based on some important levels, which is 22,900 on the downside for this strategy and 25,700 on the upside. So if this strategy expires between 25,000 to between 23,000 to 25,500, we make roughly 8,000 rupees profit per lot, which is a very healthy return considering the margin which you deploy. I think easily, I think on a 1.5 to 2 lakh margin, 8,000 rupees works to around 4 to 5% return, and that's a pretty good return because VIX is high, option premiums are pretty juicy, and this is a massive range you get to work with. And I think this is the best strategy to approach for the month of March. Yes, it's a bit volatile, but major damage has already happened in the last 4 days. News is out, and from here, I think the same news flow will continue. There will be bouts of positivity, more bouts of negativity, but eventually I believe the range of the support of 24,000 to 25,000 is where the market should spend a major time of its month in the month of March, is what my sense is. So in this short presentation, we have given you a roadmap for directional traders where your key buying points should be positioned and where you should be looking to exit your buying points in case you get it right. We have given you how the derivatives placement is, which sectors you should be watching for, and the best option strategy to work for the month of March. I think for this volatile month, this is a best cheat sheet you can have considering the volatility scenario everyone is going through. Besides, our calls are going fabulous in this volatile market. Do follow us on our WhatsApp broadcasting channels or on all our updates which we share in our reports. We will do our best to keep you updated and serve you the best in these volatile conditions. So thanking you all for giving your time to JM Financial and hearing me out. We open this forum for the Q&A session. Thank you. Well, yes. So right now, there was a time before when VIX was roughly around 10-12%. So making that 2% was gold because premiums were not on offer. And the only strategy which I think more than 80-90% of F&O traders devise is the iron condor. If you want to, kind of hedge your strategy, the same strategy which I discussed in my presentation. Or you can go with a naked call and put writing, but that would work best when situations are not volatile. So, in normal market conditions with an iron condor or the short strangles, you can target up to 1-1.5% per month as safe strategies where you define a box, where you define a range, and if the market expires in the range, you get the best of the markets. That's 1-1.5%. Obviously, when things go out of hand, you need a lot of firefighting. For which you need an expert where you can always consult us. But this is the go-to strategy in most of the situations. Second is for stocks, it's the covered call strategy where against your stock holdings, when a new expiry starts, you have to sell calls which are almost 8 to 10% away from your current market prices. So out of 12 months, stocks rarely move 10% plus in a given month. It is those 2-3 months where stocks do have their time. where things where you might miss the major chunk of the move if you were sellers in calls. But with expert advice, if you do connected to us, we can help you out as to which are those months where you should not be selling calls or doing covered call strategies. But if you ask me, if I were to give a solution to the question you asked, covered call strategies for stocks and iron condor or short triangles are the best strategies to hit a target of 2% per month. That's the answer to the question. Yeah, for monthly stock options, the best strike, it all depends on the time where you're placed. Now, really during the beginning of the month, that's the time when the time depreciation is not hard on the on options premium. So in the first 10 days, we would dissect the month in the first 10, the mid 10 and the last 10. The first 10 days is where you can try for buying deep out of the money, call or put options depending on the view you have. So if options are all about timing, it's all about your skills, about how you time the momentum. If you are good at it, then as soon as you come up with a trade setup of a buy or a sell, out of the money, deep out of the money options is what you can look forward to within the first 10 days when an expiry starts. In the mid-month, the mid 10 days, you can go for just 1 or 2 strikes out of the money from the spot to time via options route. And in the last 10 days, especially, that's the killer time, because that's when options are highly prone to time sensitivity. One day of wrong timing can just wipe off 25 to 50% of your options premium. Here you need to be perfect in your timing, and there is no scope to go wrong. So here, when you choose the strike for options, you have to go for in the money option buying if you are an option buyer. So dissection of choosing the strike based on time is what I would advise, and I've told you exactly what is the right way to approach. This is how I normally approach, and I think this should do justice to your option trading. Option premium calculation would not do justice in our short time span of the webinar which we hold. We can have a detailed webinar for the same. To speculate the market direction, what you have to do is you have to keep on monitoring the option chain. Now, when you trade derivatives, your knowledge of technicals is also a must, because technicals is the first point, for me at least, to figure out as to which will be my entry and the exit points, where the trade setup lies. So for spotting a trade setup, knowledge of technicals is a must. What indicators you use is as per personal convenience, but spotting a trade setup, you need to know technicals. Second, derivatives will tell me as to what the positioning is. So if you were to try to figure out where the support and resistance lies for a stock, you need to see the option chain on the NSE. The strike which offers the highest open interest inputs is normally the strike where the support is. The strike where the highest open interest is in calls is where the resistance is. So during the monthly life of an option, whenever the extreme ends of this band where the support and resistance are hit in the momentum of the market, immediately you should be hunting out as to when the support or the open interest bar is hit, whether there is shedding or not. If there is no shedding, then you can expect the support to be respected and a bounce back. In that case, we'll look for buying opportunities. If the open interest is weakening when the support is tested, the open interest is showing a shedding indication. That means the open interest is weakening, and you need to then hunt for where the next open interest is building on the lower strike, and then you search for selling opportunities. The same logic applies on the buying side. So this is normally one way I would advise option traders to look at open interest and technicals and take a trade based on the options chain.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.